MBA first year, first semester students. Now, we are going to learn about introduction to company accounts in the subject accounting for management. In the block 2, we are going to study the about final accounts. Under that one, in this present lecture, we are going to discuss about what about company accounts, what are the various types of shares, what are the various types of companies, and so on and so forth. In this part 1, we are going to understand about the basic fundamentals of the company and other what are the characteristics of the company and so on. Now, we know that we are purchasing so many types of products, services in our daily life. When we are buying goods from different businesses, there are different forms are there. If a single person running the business for the purpose of making profit, then it is called as sole trading concern. When 2 or more persons are running the business for the purpose of making profit or any other purpose, legal purpose, then it is called as partnership firm. So, when you go about a company form of the business organization, it is next level to the partnership firm. From when we talk about the company form of business organization, it is the next level to the partnership firm. What is the meaning of a company? Company word is taken from the 2 Latin words, one that is and mixture of another one, that is association of persons working together for a common meal, or otherwise group of persons working together for the purpose of doing business. So, normally we speak about company, that is artificial person created by law having a separate legal entity with a perpetual succession and a common seal. So, what is exactly the meaning of all this? According to section 2 subsection 13 of Indian Companies Act, company is one which is registered under the Companies Act or under any previous law. So, when we talk about the word company, it is an artificial person. Why the word artificial person is used? It is not actual human being, but it is registered and it is created by law. That means, when you register a company under the Companies Act, the total governance will be done by the law and it is having a separate entity. That means, company will have a separate legal existence. It can file a suit against others or anybody can file a suit against the company when any something goes wrong. And another important point is that it is a perpetual succession. What is a perpetual succession? Continues forever. That means, what is the life of the company that nobody can be understood. So, we are seeing so many companies like Tata company, Birla and all. What they are doing? They are running the business for the years together or hundreds of years also. That means perpetual succession. That means, company is not going to close on any particular fixed period of time. And next one, that is a common seal. When we say a common seal, whereas it is an artificial person, a human body or a human being can sign, but whereas company is an artificial person, it cannot sign. For this purpose, a special feature that is called as common seal that is introduced in this particular characteristic nature. So, common seal is one which governs about the authenticity of the various transactions of the company. So, we also understood, now we understood that company is an artificial person which can do the business with the help of a common seal and it is an extension to the partnership firm. Then what are the essential characteristics of a company? Let us understand now. So, first one is registration. Registration of a company is a compulsory under the Companies Act. So, every company is registered under the Companies Act. Next, second point is that separate legal entity. As I told you, when the company is registered, it is separate, it is having a separate legal entity. That means, it is different from its members. Company is different, person who promoted the company is different, and even the board of directors are also considered as the separate people from the entity of the company. That means, company is totally different from the persons who promoted it or from the persons who generated it or developed it. And perpetual existence is the third important characteristic. Already I told you that there is no limited life for the company. Unlimited number of years the company will continue, that is called as perpetual existence. With the persons, with anybody who is the promoter or anybody who is a director, with his life nothing to do with the company. Even every director life is limited, but company's life is unlimited. That means it is not limited to the human being life, but at the same time company will have its own life for the so many number of years. Next, another characteristic is that transferability of shares. Company will raise the funds on the basis of with the help of the share capital. That means company will issue the shares and they are freely transferable. That means shares of one person can be transferred to the another person with very easy. Through the stock market, this transferability of shares is happening nowadays. Already we know that people are buying shares, people are selling the shares. When one person sells the share to the another person, automatically shares will be transferred. But this is not possible in case of other forms of the business units. That means shares of a company are freely transferable from one person to the another. This is a very special characteristic of a company. Next, another important characteristic is that limited liability. The liability of each individual shareholder or liability of each individual member is very much limited. That means limited to the share capital whatever he invested in the company. Let us understand this concept of share capital in the coming minutes. Then his entire liability, a person's liability or a shareholder's liability or a member's liability is limited to the value of the shares whatever he purchased. And common seal, already I explained about this common seal. It is a seal which is placed in the place of the signature. And delegated management. Delegated management means company will have a separate management team in the name of the board of directors. All the board of directors or some of the board of directors will sit together and take the management decisions. So, in lump sum we can say that company is having a specialized characteristics when you compare with the partnership firm, when you compare with the sole trading concern. Company will have a registration, separate legal entity, perpetual succession, transferability of the shares, limited liability, common seal, delegated management. All these characteristics are especially for the company which are completely different from the other forms of the business unit, that is a sole trading concern or a partnership firm. Now, let us proceed to the another important aspect, that is kinds of the business. Let us not go into the very long lengthy list of the kinds of the companies. Let us briefly sum up on some of the types of the companies, and the very important type is that on the basis of incorporation we can classify the companies as then on the basis of liability of the members like limited liability and how many number of members are there in the company and what is the ownership of the company, whether it is a private ownership or a public sector company or a government company, and which basis ownership is there, that is also considered as a company. So, for example, a company is owned by the government, that is called as a government company. If a company is owned by a public sector, then it is public sector company, and people can invest in if the people can invest in the shares of the company, that is a public limited company. Then let us proceed to the another important aspect as an introductory part into the shares and stock. What is a share? What is a stock? Company generally acquire their financial resources by issue of the shares, which is a special characteristic feature of the joint stock company. So, share, what is, we normally know about these things in a general market also, buying shares, selling shares, share market, shares values are coming down and share values are increasing up and so on and so forth. But we rarely hear about the word stock also. What is a share? What is a stock? Share normally is the smallest part of the capital, and if the capital is divided into various smallest parts, then it is equivalent to the share. For example, a 1 lakh, 10 lakhs capital, if it is divided into 1 lakh shares of 10 rupees each, then that 10 rupees value is considered as the face value of the share. That means, share is the smallest part of the capital what a people will assume. Next, it represents the ownership or the membership of its holders in a company. If a shareholder, that means a person who purchases a share of a company, then he represents the ownership or he is a member of its holders in a company. When the shares are allotted to him, then he immediately gets the right and he immediately become a shareholder of the company, and he will be a member of that particular company, and he is a representative of the ownership of the company. Then stock is the aggregate value of the fully paid shares. What is fully paid? Let us discuss at later stage. If all the value of the face value of the share is completely paid by a person to the company, then the aggregate value of all the shares that is put together, we call it as a stock. That means stock is a aggregation of fully paid shares. What is a fully paid share? When the face value of the share is 10 rupees, normally companies will collect the money in various subparts like on application, on allotment, on the first call, and so on and so forth. Normally nowadays companies are taking the full amount at the very beginning itself, or sometimes they will give on allotment also. As far as academic point is concerned, we will consider that shares are allotted in the various stages. So, if any share value is completely paid by a person to the company, then it is called as a stock. Aggregation of all the fully paid stocks shares is considered to be the stock. So, share is the smallest part of the capital, whereas shares aggregate value of all the shares which are fully paid, then it is considered to be the stock. Then let us go into the analysis of the various types of the shares. What are various types of the shares? Shares are classified on the basis of the preference, on the basis of participation, and so on. Let us understand about first of all preference shares and equity shares. These two are most popular types of the shares what a company normally will issue. Let us understand about issue of share by a company. About equity shares, let us understand first. This issue of shares normally for the purpose on the basis of cash. So, when you are issuing the shares on cash, that can be done in three subparts or in three ways. Then first one, that is at par. What is the meaning of at par? Let us go with that. At par means a company share is 10 rupees, let us assume. Then the total value, whatever money that is collected from the public, that is if 10 rupees only, that is called as at par. That means if the share value is 10 rupees, if the buyer of the share need to pay only 10 rupees, then it is issue of shares at par. That means we are issuing the shares on the face value of the share itself. Next, second category, that is at discount. Shares may be issued at discount by the company. What is at discount? When you release the shares or issue the shares at a lesser than the face value or lower value than the face value, then it is considered as at discount. So, if a 10 rupee share is issued to the general public at 9 rupees, then that 1 rupee is considered as a discount, and only 9 rupees will be collected from the general public, whereas that 1 rupee is considered as a discount by the company on the purchase of the shares. Last third one, that is at premium. When the company is having so much of goodwill and it is company is sure of getting the share capital from the general public, they will issue the shares at a higher price than the face value. That means a 10 rupee share will be issued to the public at 15 rupees or 20 rupees also. Then that whatever the money they are collecting from the general public above the face value, that is called as premium. If a share is issued at 15 rupees, then that 5 rupees extra than the face value 10 rupees, that is considered as a premium. That premium is to be shown in the liability side of the balance sheet under the head share premium account. Total amount that is considered from, that is collected from all the shareholders, which is excess of the face value, that is considered as a share premium. That means in lump sum, if a company issue the shares at face value, that is called at par. If a company issue the shares to the public at lesser than the face value, it is at discount. If the company issue the shares above the face value, that is called premium. So, in 3 ways the company can issue the shares to the public. Now, let us understand another type of issue of the shares. Sometimes instead of collecting money from the general public, companies can issue the shares to the vendors. Who is a vendor? Vendor is one from whom the company purchases any asset. That is, if a company buy a building from a person, company can issue the shares to that particular person instead of paying the cash. So, company can buy a machine, then also company can issue the shares to that vendor. That means to the vendors, if the instead of cash, if the shares are allotted to that particular vendor, then it is called as issue of shares for other than cash. Next, to the promoters also the shares are always allotted. When a person who promoted the company, then to him also the company will allot the share. As I told you, promoter is different, company is different, because company is having a separate legal entity. It is different from the promoter. So, promoter also will get shares from the company. So, if other than cash, if the company is allotting the shares to the vendor, then otherwise to the promoters and so on. So, this is the point where to understand. And another important concept is that when the company issued the shares to the general public, let us assume that a person, Mr. X, applied for the shares and he paid money, application money, but later on he is not able to pay the remaining amount of the share face value. Let us assume that on application, if the company wants to collect 1 rupee and the remaining 9 rupees is collected in the allotment time, first call and second call and so on. If a person is not able to pay that remaining amount after application or after allotment, company will have a right to forfeiture of the share. The forfeiture means withholding the right of the person, withholding the right from the person who is allotted with the share. When once share allotment is over, if the person is not able to pay that money, then the shares are forfeited. For this means any default from the payment, any default in the payment from the purchaser of the shares, the company can withdraw the shares from that particular person and it can forfeit its share. What to do with it, with this type of shares? When the shares are forfeited, then that type of shares are again reissued to the general public, that is called as reissue of forfeited shares. To understand here, that is forfeiture means withholding the right from the buyer of the share because of non-payment of the money. Then again if the forfeited shares are reissued to the public, that is called as reissue of forfeited shares. This happens in the case of the share issue always, many of the times. Then let us understand about another important concept of preference shares. So, what is a preference share? Why it is called preference share? Normally the word preference is known to us. Some sort of preference will be given to that particular person who acquired that particular share. So, on the case of, in this particular context, let us understand the word dividend. What is dividend? When the company is having profits, profits are distributed to the shareholders. When you are distributing the dividends to the shareholders, then every part of the profit is known as dividend. So, when dividends are issued with the help of the company profits, let us understand that in case of preference shares, they are entitled to a fixed amount of dividend, but in the case of equity shares, they are entitled for the dividend on the basis of quantum of profits. If higher the profit, the equity shareholder can get more amount of dividend. If lesser the profit, the equity shareholder will get lesser amount of profit. To be frank, if there is no profits or if the company do not want to declare dividend, the equity shareholders, for them there is no dividend at all. But in case of preference shares, it is different. They are entitled for a fixed percentage of the dividend. Say for example, 9% preference shares, that means they are entitled for a fixed dividend at the rate of 9%. That means their dividend is fixed a percentage, where whenever there is a profits, first the preference shareholders are to be paid with the amount of dividend, and after payment to the preference shareholders only, the equity shareholders will get the dividend. So, that is called priority, that is called preference. With the out of the available profits, first the company has to pay the dividend to the preference shareholders at the agreed fixed percentage, and then only the dividend payment will be forwarded to the equity shareholders. Next, at the time of repayment also, when the question of repayment will come? When the company is winding up, or it is in liquidation stage, or if the company wants to reduce its capital. In any of these situations, repayment priority will be there for the preference shareholders. At the time of liquidation of the company also, first the payment should be made to the preference shareholders, then only the payment should be forwarded to the equity shareholders. So, at the time of dividend payment or at the time of repayment of the capital, in both the cases preference shareholders will be given the priority. So, in this context we understood that very clear, preference shareholders enjoy a special right above the equity shareholders. Equity shareholders are considered as a residual owner, whereas preference shareholders are prioritized owners. So, they will have a priority and they will have a special right above the equity shareholders. So, this is another type of shares. So, we can understood that shares are two types, one is equity share, another is a preference share. Equity shareholders, they are the risk bearers, and for any loss also they will bear, and in case of preference shares, fixed percentage of the dividend is guaranteed. So, at the time of priority, at the time of liquidation of the company or at the time of winding up of the company, also preference shareholders will be given a specific advantage, and then only the benefit will be passed on to the equity shareholders. This is two types of shares, how normally the company will acquire the funds from the general public for the purpose of their capital formation. So, these are the another important type of the shares. Next, how many types of preference shares are there? Normally, preference shares, as already we know, they are having a priority above the equity shareholders, but at the same time so many types of preference shares also can be issued by a company. That is one. First one is a cumulative preference shares. When cumulative shares are that, cumulative preference shares are the shares where the dividend is cumulative. That means first year, second year, third year, fourth year, as long as dividend is not paid, the value of the dividend will be continuously cumulative, and whenever the profits are there, company has to pay the dividend to the preference shareholders. Another type is that non-cumulative. What is the meaning of non-cumulative? When the profits are not sufficient, that will not be accumulated. If the profits are sufficient or profits are there, they will pay for that particular year to the preference shareholders. If the company is not able to pay the dividend in any particular year, then dividend will not be accumulated. Another one, participating preference shares. They will participate in the management meetings, voting and all. Another one, non-participating preference shares. Then they will not have any participation, that means voting right for their shares. Convertible preference shares. Convertible preference shares are the shares which can be converted to equity shares over a period of time. That means after a specific period of time, if it is accepted by the company, then finally they will be converted to equity shares. Non-convertible preference shares are the another important category. That means they are not convertible, that means they will remain as preference shares only in the company form of organization. Then redeemable preference shares. What is redemption? What is redeemable? Then redemption means after a specific period of time, they will be paid off about with their capital, and finally they will be redeemed from the capital. That means the capital is paid off to the shareholders, and from that date onwards they will not have any ownership, or they will not have any they are not the members of that particular company. That is called a redeemable. Sometimes companies will issue irredeemable preference shares also. These irredeemable preference shares are the preference shares which cannot be redeemed by the company, and they will be in the company for the lifelong existence. So, these are the various types of the preference shares. So, starting with cumulative, that means dividend is accumulating year by year. If 1 year dividend is not paid, that dividend will be paid along in the next year whenever the profits are there. Non-cumulative, dividend will not be accumulated. Participating preference shares will participate in the voting right and general body meetings, etc. Non-participating preference shares are the preference shares which are not participative in the annual general body meeting, etc. Convertible in the sense they will be converted to equity shares, non-convertible means they will not be converted. Redeemable preference shares are the shares which are redeemable after a specific period of time according to the prior agreement, and irredeemable preference shares are the shares which will not be redeemed over the period of time. With this small introduction aspect, we covered in this particular lesson about we covered about what is a company. Company is above the sole trading concern partnership form. Company is an artificial person created by the law and it is separate from that. Then we understood about characteristics of the company, that is characteristics of the company, that is separate registration, legal entity, perpetual succession and so on. Then we understood about various kinds of the companies on the basis of incorporation, liability of the members and ownership and so on. Then how many ways the company can acquire the funds. Out of that, the very best way is shares, that is share is the smallest amount of capital through which the company acquire their long term resources. Stock is the aggregate of all the value of the shares. Then various types of shares are that is preference shares and equity shares. Equity shares are issued at par, at discount, at premium. At par means issuing of the shares on the face value, and at discount means issuing of the shares at lesser than the face value. At premium means issuing of the shares at more than the face value of the shares. Then we understood about issuing of the shares for other than cash, that is to vendors from whom we purchase various fixed assets like buildings, plant and machinery, etc. and sometimes shares are also issued to the promoters. Then we understood about forfeiture and reissue of shares. When the purchaser of the shares after allotment, if he is not able to pay the money to the company, that withholding of right will be there with the company and company will forfeit their shares, and these shares are again reissued by the company. And preference shares are entitled for a specific right, that is fixed dividend, and repayment priority will be there for them. And various types of preference shares already just now we understood: cumulative, non-cumulative, participative and non-participative, convertible and so on. Thank you very much.